Good day everyone, we are the Alpha Consulting Group, your strategic consultants, here to conduct an internal analysis of Dutch Bro's business landscape and growth opportunities. In this presentation, we will examine Dutch Bro's firm profile on their history, key personnel, and BMC. We'll also look into environmental survey through Pestle and examine major rivals, analysis of their financials, value chain, strategy, and resource and capabilities. To start, let's delve into Dutch Bro's history. Dutch Bros Inc. was founded in 1992 in Grants Pass, Oregon, by brothers Dane and Travis Bursma. Initially operating as a small pushcart selling espresso, the company rapidly expanded, leveraging a unique drive-thru business model and a strong customer service culture. Today, Dutch Bros has grown into a publicly traded company with hundreds of locations across the United States, emphasizing community engagement and a high-energy brand experience. Dutch Bros' mission and values center around creating a positive impact through exceptional coffee experiences while fostering meaningful relationships with its communities. While the company excels in brand authenticity and customer engagement, there are definitely opportunities for refinement. Starting with the pros, it's engaging, upbeat, and perfectly reflects the Dutch Bros brand. It emphasizes community impact and spreads positive energy. And due to its energetic tone, it's definitely memorable. However, it lacks specifics on measurable goals or how they plan to make a difference. It also misses a clear mention of their core product, coffee, and doesn't touch on sustainability efforts. To strengthen Dutch Bros' mission statement, it could clarify what making a massive difference means. Mention coffee to reflect its core business and include measurable long-term goals like innovation or community impact. At the same time, it should remain broad enough to allow for future growth and new initiatives. It is also worthy to note that Dutch Bros currently lacks a formal vision statement that outlines its future aspirations beyond growth and community involvement. A strong vision statement should inspire stakeholders and provide strategic direction. So let's go over quickly for Dutch Bros' current key personnel as seen in the slide. Dutch Bros' executive team and board play a crucial role in strategic decision-making and overall company performance. As of 2023, these are the key figures leading Dutch Bros Inc. Now let's dive into how the company's broader business model supports its success. Dutch Bros operates a robust business model centered on speed, convenience, and personalized experiences. Its key partners including franchisees, suppliers, technology providers, and local communities enable efficient performance of key activities such as drive-thru operations, menu innovation, supply chain management, employee training, community involvement, and marketing and branding, which reinforce its value propositions, which is customizable menu, community focus, and a fun, energetic brand. The company relies on key resources like its baristas, drive-thru infrastructure, supply chain, brand reputation, technology, and intellectual property to deliver on these promises. Through channels like drive-thru locations, walk-up windows, its mobile app, social media, and their website. Dutch Bros fosters customer relationships via personalized service, loyalty programs, community engagement, and social media interaction. Dutch Bros targets primary customer segments of young adults, millennials, and Gen Z, while also catering to families, professionals, and coffee enthusiasts. And they also cater to community-oriented customers. Its revenue streams include beverage sales, merchandise sales, franchise fees, and mobile app purchases. Meanwhile, costs are driven by operational expenses, employee wages, supply chain costs, marketing expenses, technology investments, and franchise support. So this is Dutch Bros' business model. Next, let's move on to Pestle analysis.
Starting off on our Pestle analysis, Dutch Bros operates in a heavily regulated industry, particularly concerning labor laws, food safety, and environmental policies. The National Labor Relations Board's evolving stance on joint employment could pose significant risks, increasing liability for franchisees' employment practices. Additionally, minimum wage hikes such as California's AB 1228, which raises fast food wages to $20 per hour, can escalate labor costs. To mitigate this, Dutch Bros has strategically responded by offering above minimum wages, employee stock options, and flexible scheduling to maintain a competitive workforce. Consumer trends significantly shape Dutch Bros' market position. The brand has successfully aligned with the growing demand for specialty coffee and energy drinks, particularly among millennials and Gen Z consumers. A majority of its customers are under 35, reinforcing the importance of customizable, visually appealing beverages. Health-conscious trends also influence product innovation, with Dutch Bros expanding plant-based milk options, sugar-free syrups, and functional ingredients to meet evolving preferences. Economic factors such as inflation, rising wages, and increased supply chain costs are key economic challenges. Dutch Bros' business model relies on consumer discretionary spending, making it sensitive to economic downturns. However, its drive-thru-centric approach offers a strategic advantage by catering to convenience-driven customers. Interest rate fluctuations also impact the company's expansion, as higher borrowing costs could slow growth. Dutch Bros must navigate these economic shifts by optimizing pricing, enhancing operational efficiency, and maintaining a strong brand presence. For environmental factors, climate change presents long-term risks, particularly in coffee bean sourcing, as Dutch Bros depends on Central and South American suppliers vulnerable to environmental shifts. Regulatory pressures such as waste reduction laws and carbon emission reporting requirements further necessitate sustainability initiatives. Dutch Bros' ongoing investments in eco-friendly packaging, emissions reduction, and ethical sourcing demonstrate its commitment to environmental responsibility. As for technological factors, Dutch Bros leverages technology to enhance customer experience and operational efficiency. Mobile ordering, AI-driven recommendations, and digital payment integration have strengthened customer loyalty. Further advancements such as automated coffee machines, AI-driven inventory management, and blockchain-based supply chain tracking could drive cost efficiencies and enhance sustainability efforts. As a franchise-driven company, Dutch Bros must comply with federal and state franchise laws, which govern contractual obligations with franchisees. Additionally, data privacy regulations like CCPA require the company to implement robust cybersecurity measures. The growing risk of class action lawsuits, whether related to labor practices, food safety, or consumer protection, highlights the importance of proactive legal compliance and risk management strategies.
Dutch Bros, a rapidly growing coffee chain with a focus on a drive-thru convenience and customer loyalty, faces significant competition from established players like Dunkin', Starbucks, and McDonald's. Starbucks started as a small coffee bean retailer in Seattle in 1971. Over the years, it has grown into a global brand with over 38,000 stores in 80 countries. The US remains its largest market, hosting 17,049 stores, or 42% of its global portfolio, while China is the second largest market that has 7,685 stores. Next, McDonald's has established itself as a major player in the coffee market through its McCafe, which now operates in 38,000 locations worldwide and generates $4 billion in annual sales. Launched in 1993 in Australia and expanded globally in 2009, McCafe has grown to become the number 3 coffee chain in the US by a market share of 6.5%, trailing only Starbucks and Dunkin'. Lastly, Dunkin', formerly known as Dunkin' Donuts, stand as one of the world's largest coffee and baked goods chains, operating over 14,000 locations across 39 countries with about 8,500 stores in the US alone. Founded in 1950, Quincy, Massachusetts, the company underwent a strategic rebranding in 2019 to Dunkin' to emphasize its beverage-focused identity while maintaining its iconic donut offerings.
Now let's look into the company's financial health. Starting with the horizontal analysis, we discovered that
Dutch Bros is still growing, but that growth is clearly slowing. Total revenues remain strong with a 4-year compound annual growth rate of nearly 42%, though year-over-year gains are tapering off. Company-operated shop growth has cooled, down from 61% to 34%, while franchising remains minor and erratic. Costs have grown alongside revenues, but better control in 2023 hints at improved margins. Selling, general, and administrative expenses has been a roller coaster, and operating income has turned increasingly negative, signaling deep profitability challenges. Rising interest expenses and unpredictable other costs are also weighing down earnings. On the balance sheet, cash and assets surged, fueled by financing and long-term investments, but liabilities, especially long-term debt, have also grown fast. The good news? Operating cash flows showed a strong rebound last year, but with revenue growth slowing and profitability still under pressure, Dutch Bros may be entering a new phase, where efficiency and execution matter more than expansion.
Moving on to the vertical analysis, we discovered that
from 2019 to 2023, Dutch Bros shifted its focus. Company-operated shops surged from 64% to nearly 89% of the total revenue, while franchising dropped to just 11%. Cost of sales crept up, peaking at 75.5% in 2022, hinting at inflationary pressure. Though a slight improvement in 2023 suggests early margin recovery, SG&A expenses spiked in 2021, likely from IPO activity but were reined in by 2023, reflecting better cost control. Operating income fell hard, turning negative in 2021, but bounced back to 4.8% of revenue in 2023. Interest expenses rose to 3.3%, showing increased debt pressure. Net income followed a similar arc, recovering to just 1% in 2023. On the balance sheet, total assets ballooned through 2022, then stabilized, while liabilities followed a similar path before dropping sharply in 2023, indicating a pivot toward healthier financial management. Cash rose to nearly 40% of assets, inventory shrank, and operating cash flow modestly improved, small steps forward in liquidity and efficiency. Dutch Bros isn't fully back yet, but the foundation for recovery is clearly taking shape. Let's take a look at their financial ratios.
And lastly, for ratios.
From 2019 to 2022, Dutch Bros faced serious liquidity challenges. Its current ratio dropped as low as 0.4, signaling trouble covering short-term obligations. But in 2023, things turned around. The ratio jumped to 1.5 and working capital flipped back to positive, hinting at better cash flow management and improved short-term solvency. However, debt-related metrics tell a more cautious story. Interest coverage remained volatile and mostly negative, and while debt ratio improved from nearly 79% to 62%, liabilities are still high relative to assets. The company's profitability is also a wild ride. After strong numbers in 2019, margins and returns collapsed into negative territory by 2021, but by 2023, they began creeping back up. Net margin hit 1.2%, return on assets reached 0.6%, and return on equity climbed to 1.5%. Still, these gains are modest, and the company's operational performance remain under pressure. Efficiency metrics paint a mixed picture. Inventory turnover has been stable since 2021, showing solid inventory control. Fixed asset turnover peaked in 2022, but recent data is missing, and total asset turnover continued its decline, meaning the company's growth in assets hasn't yet paid off in revenue. Dutch Bros has clearly made progress, but it's coming out of a financially unstable period, which is the pandemic. The DuPont breakdown shows the same pattern: a strong start in 2019, a steep fall during the pandemic, and only minimal recovery by 2023. So here's the bottom line. Dutch Bros is improving, but to sustain growth, it needs to boost profitability, keep debt in check, and make its assets work harder.
Moreover, the group performed a value chain analysis for Dutch Bros, starting with inbound logistics, the strategic coffee sourcing from Central and South America with 18 to 24-month price locks provides exceptional cost stability, while maintaining 4 months of inventory across 15 distribution centers, creating supply chain resilience. In operations, Dutch Bros' fully integrated roasting facility ensures quality control, while the industry-leading drive-thru models featuring runner baristas and escape lanes delivers unmatched speed, and having 3 standardized shop configurations provides scalability. Also, outbound logistics benefit from minimal waste through made-to-order production and the highly successful Dutch Rewards app, which now drives 65% of transactions through its seamless digital experience. For marketing and sales, the Dutch Love philosophy creates authentic customer connections that competitors can't replicate. Promotional strategy including feel-and-trade campaigns and secret menu items effectively drives traffic, while community initiatives like Buck for Kids strengthen brand loyalty. The service experience is differentiated through the barista training program that emphasizes personalization and rapport building, supported by rigorous quarterly quality inspections. On the support side, corporate structure provides clear operational governance, and a compliance framework mitigates regulatory risks. The people-first culture, competitive compensation, and leadership pipeline create a talent advantage that's difficult to imitate, and technology investments in the loyalty program and beverage tap systems demonstrate forward-thinking innovation, while the procurement strategy, including approved vendors and commodity hedging, effectively manage cost pressures. Moving on to its current strategies, Dutch Bro plans to reach 1,000 shops by 2025, focusing on data-driven expansion in the Midwest and East Coast. It maintains quality control through a company-operated model with selective franchising for top performers. Key operational strengths like a 4-month coffee inventory buffer, commodity hedging, and a bag-in-a-box beverage systems ensure cost stability as it scales. Aside from that, the Dash Rewards app drives 65% of transactions, supported by AI-driven staffing and rotating seasonal drinks to boost retention. Beyond digital, its community focus, including a $4.3 million annual giveback program and local initiative, builds unmatched brand loyalty. With $700 million in liquidity, Dutch Bros reinvests its growth rather than dividends. Its culture-first approach, powered by Dutch Bros University and competitive pay, preserves its people-centric magic while scaling. And next is a Rio analysis of Dutch Bros' key resources and capabilities. First, their proprietary coffee blends are highly valuable for quality differentiation. Their unique recipes, combined with roasting expertise and long-term bean contracts, make this resource both rare and difficult for competitors to imitate. This is perfectly organized through their controlled supply chain, creating sustainable competitive advantage. Second, the Dutch Rewards loyalty program delivers exceptional value with its 65% transaction penetration. Its rare combination of data analytics and app integration would be costly for competitors to imitate, and personalized marketing fully embedded in operations, this represents another sustainable advantage. Third, the barista culture provides immense value through distinctive customer service. This rare people-first approach is culturally embedded and extremely difficult to copy quickly. With structured training and internal promotion pathways, Dutch Bros has perfectly organized this to capture maximum value. Their drive-thru model, while valuable for convenience, isn't as rare as competitors can easily replicate it. And franchise partnerships provide geographic reach but offer no lasting differentiation. Lastly, philanthropic initiatives create value but remain at competitive parity with other quick service brands. After analyzing the internal analysis and to strengthen Dutch Bros' competitive position, we recommend focusing on 7 priority areas. First, establish measurable mission and vision statements to better guide strategic decisions. Second, accelerate technology adoption, including AI drive-thrus and automation to improve efficiency. Third is to address operational fundamentals by improving order accuracy and implementing stronger financial controls. Fourth, enhance governance through formal succession planning. Fifth, expand plant-based and health-conscious menu options to meet evolving consumer preferences. Sixth, differentiate your community initiatives beyond standard industry practices. Finally, demonstrate scalable profitability before pursuing additional aggressive expansion. These recommendations balance growth with operational excellence, ensuring Dutch Bros maintains its unique culture while building sustainable long-term success. With that, we end the entirety of Alpha Consulting's internal analysis of Dutch Bros.